You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And today, before we start out, I just want to remind you that there's this website called wealthformula.com, which you are going to want to check out if you want to get involved with this community at a higher level. And that's where you can get a number of resources. It's not available on the podcast itself. And also, it's where you can sign up for various lists to get more involved in our community. One of those is the Accredited Investor Club, which is the place to be if you're interested in potentially not just listening and being a podcast groupie, so to speak, and actually put your money to work for you. Get that lazy money off the sideline. If you're an accredited investor, go to wealthformula.com and sign up for our Accredited Investor Club. Now, let's talk about today's show. Okay, this show is interesting because I've kind of alluded to this in the past in my analysis of what's going on in the economies. You know, for the last 15 years, it's really been a game of chicken between the Federal Reserve, fiscal policy, and even in financial markets, right? So Federal Reserve and fiscal policy on one side, financial markets on the other side, including real estate, equity markets, et cetera. And they're all driving, you know, like there's these old movies, right, where in the 1950s, and you get these kids in these cars and they start driving toward each other as fast as they can. And then the game of chicken is lost by whoever suddenly turns away quickly to avoid collision and certain death. Now, similarly, the financial markets and the Federal Reserve have been trying to figure out who would chicken out first, right? So let me give you an example, right? I mean, it's a very recent, easy thing to look at. And I mean, despite COVID shutting down the entire country, the asset markets, well, after a quick, huge drop, right? They go on within months to going sky high. Why? Because investors knew that the Fed would come in and rescue them as they did. Rates dropped to zero. There was quantitative easing. Bond markets were controlled for that reason. Interest rates and a ton of money into the hands of institutional investors, banks, etc. That's what happens, right? And we saw that pattern happen before too. We saw it in 2008. And so it has created a little bit of a paradigm where, we learn from what's happening. If you Pavlovian dogs, smelling whatever thing they do, and all of a sudden they get hungry. I mean, it's the same kind of thing, right? Like it's you learn from your experience, and when you learn that you can make big bets, and then if you lose, then you're going to get bailed out. I mean, it's like going to if you were at the casino. I mean, wouldn't you keep playing if the house guaranteed you wouldn't lose money at the end of the night, right? I mean, you're down to 6,000, 8,000, whatever. But don't worry, we're okay. We're not going to let you get out of here, without at least making your money back. And that's the way investors came to see the Fed for the last 15 years. And it's not just the Fed, but it's Fed and fiscal policy too. They see it as an insurance policy. Okay. And by the way, I say they, but I mean, and when I'm talking about institutional investors, but we all massively benefited from that, especially if you were an investor club, you saw, these huge, we do value add, but we had a significant asset bubble on top of that as well that we actually benefited from. So when we got this whole inflation thing on Main Street, right, because that's the recognized inflation, and that happened because of the massive amount of helicopter money injected from the Biden administration, and also, the supply chains creating huge demand, labor markets became very competitive, driving wages up, et cetera, and all that too. But when all that happened, of course, the Fed started raising rates again. And at first, the market shrugged it off because, well, they were playing chicken again, right? But then the Fed kept raising rates, and all of a sudden it's not really quite as clear who's going to blink first, right? It's not the Fed that's going to definitely like go on the, make that quick turn right before the collision. So now, there's a little bit of rockiness in the markets. They're not doing great. Real estate has been tricky too. And that's because the Fed has been very clear about getting inflation under control. They know it has to be done, and that's finally getting through to some investors. Or is it? That's the question, right? Actually, we also know that we can only raise rates so much, right? Before you get a serious problem in the global financial situation with sovereign debt and all that type of thing. And if we end up in a massive recession because of rate increases, well, many investors think, that may actually happen and that rates are going to go back down, and they may or may not be right. But the moral of the story is that there's now a well-established disconnect between the economy and financial markets. That's the new normal. And that is the question that Nomi Prins, who I think is one of the smartest financial authors out there, has written about in her new book. So when we come back, Nomi Prins on the Great Distortion. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast is Nomi Prins. She's an economist, geopolitical financial expert, and investigative journalist. She is also a great financial author, and she has written multiple books, including All the President's Bankers, Collusion, How Central Bankers Rigged the World, and the most recent book, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Thanks for joining the show, Nomi. How are you?
I'm great. Thanks so much for having me on. It's very choppy times we're living in right now.
Yeah. And let's just start off. I mean, the title of your most recent book is very telling. I mean, it kind of tells the story right there, right? Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. So, I think many people who are not economists like myself and who are just following what's going on, and it's really what's been going on since maybe 2008, have noticed this idea that, hey, the economy and recession doesn't mean, it doesn't really reflect on markets. I mean, during COVID, the businesses were non-functional, but the markets were still going up. Is that essentially kind of when you talk about the permanent distortion of the economy, is that what you're referring to?
Yeah, that's it in a nutshell. And yes, that title and the subtitle were very specifically chosen to not just say there is a distortion now, but that the distortion that has developed since 2008 between the markets and the real economy has actually become permanent. It's like we're not going back. And there's two ways that the market outperforms, effectively does better than the real economy. One is when there is a crisis, whether it's a financial crisis or whether it's a COVID shutdowns, and there's all this money that is created at the hands of the central banks, the Fed and other central banks around the world that have the ability to effectively inject or basically liquefy the markets with money that they create, and they buy back from the market's debt. So they basically inject money and extract debt, but it doesn't really help the real economy to do that. And so what happens is the markets inhale that injected money. I'm probably mixing metaphors here, but they inhale what comes at them. And as a result, they balloon in different ways. The stock market, the bond markets, the real estate markets, and so forth balloon in different ways when that heavy injection is coming in. When it goes out, there is some pain for the stock market, as we're seeing right now, in the bond markets and the real estate market a little bit, but it's nowhere near the pain that the real economy feels for various reasons, from not having participated in the upside to all of the higher costs of everything from utility bills to food bills to medical bills. And so there's always this distortion between where the money goes and what it helps versus the real economy, and most people that live in the real economy that are impacted on the negative side, either way, if the markets are going up or if the markets are going down.
What do you think was the precipitating factor in this? Of course, as you mentioned, was 2008 and the meltdown. At what point do you think this went from a short-term panacea to a permanent distortion?
So that's a really good question, because I written a book after the financial crisis, well, a couple, but the one that specifically looked at the central bank's kind of role in creating the first part of the distortion. My book Collusion was basically how a lot of central banks around the world in the wake of the financial crisis created all this money. It went into markets and so forth. And the real economy, GDP, for example, stayed effectively around zero, give or take. At most, it was sort of 2% per year but for the most part, it hovered between, sort of minus and 2%. So really, the economy wasn't really going anywhere, but the market was going up quite a lot. And so that was sort of when distortion was accelerating. But where it became permanent was when the economy was shut down effectively, and what the Federal Reserve did and other central banks, they didn't just inject some money; they doubled in a few months the amount of money that they had injected during all of the years that precipitated that from the financial crisis of 2008 through 2019. So it wasn't like they just added a little bit or they distorted markets a little bit more. They doubled what they had done in all those preceding years. And that's when I think it became permanent, because two things happened. Then one is the financial system, the market system recognized that no matter what, there was effectively an unlimited amount of money that could be created in an emergency. Now, what defines an emergency is always up for grabs. In that situation, it was COVID-related shutdowns. But whatever an emergency is, there's an ability to create vast sums of money to basically flood the markets with. And what we're seeing now is what happens when the foot of the central banks is a bit taken off the gas pedal, and they sort of start to raise rates to tighten in inflation and some of the things that they just did over the last 2 years in terms of creating money and creating all of this influx. And also seeing the markets crater as a result, because the markets want this cheap money. They got used to it. They got dependent on it. In the book, I call it an addiction.
Sure.
And so what we're seeing now is what happens in withdrawal from an addiction, which is the markets are buckling, but more so the economy is stumbling and there's more uncertainty throughout. And so all of that became permanent. The upside and the downside to markets and to the economy in the wake of the COVID crisis.
It strikes me that part of this distortion has resulted in sort of this almost like a game of financial chicken between the central banks and the large institutional investors, right? Like, how much can we do and how much can we get away with? And then you'll bail us out, and we know you're going to bail us out because you've shown it over and over. That is a how do you escape that cycle? Because that to me seems like that's something that is very firm now. I feel like investors, whether it's retail investors or institutional investors, nobody really believes that the Fed is just going to just let things correct themselves.
Yeah, I think that's true. No one does believe that because of the facts. Now, what's happening right now is that Federal Reserve Chairman Jerome Powell is echoing what happened in the 80s with when then Federal Reserve Chairman Paul Volcker was at the helm, where there was multiple years of inflation and there was multiple rate hikes over time. We had rates go up to 20% for a minute, and he's basically saying, "Look, inflation's really high. I'm sort of going to peg for now what the Federal Reserve policy is on this really high inflation, and we're going to, quote, do whatever it takes to get inflation down." Now the problem is, and why the markets don't believe that, besides the fact that they've shown that they can expand their book and reduce rates to zero when they feel like it, is that the inflation that Powell is talking about doesn't come from monetary policy inflation. If it did, they could have stopped it a long time ago. They've been inflating markets since 2008. Mm-hmm. It so happens it has come from a confluence of events. One is opening economies after they were shut down, which means reopening plants, which means reopening supply chains, reopening transportation change after they've been closed down. So the extra costs that incurs when things have been shut down to restart them up. And then you couple that with the fact that we've got other problems going on in the world on the food side. We've got droughts, we've got problems with fertilizers. On the energy side, we have natural gas price spikes. We have geopolitical tension between Russia and Ukraine. We have an energy mess in Europe that's going to push more of the cost of energy prices upward. So all that's happening together. So what that looks like is higher inflation, because in fact it is. But it's not something that the Federal Reserve or any other central bank can do anything about. The Fed's not going to go and like help you with your electric bill. It's not going to create oil. It's not going to create food. It's not going to create food or fertilizer. It's not a farmer. It's not a miner. It's not a producer. So the problem that's happening right now is the markets are saying, wait a minute. You're talking about fighting inflation, okay. But the inflation you're talking about fighting is not inflation you can beat. Mm-hmm. And so at some point, what you're doing is causing a choking off of financing capabilities to real people, for sure. Mortgages, for car loans, for tuition, for things that people kind of need and use in their regular lives outside of the markets. And so by raising rates, you are increasing those costs. And that can create a situation where people don't buy that next home or choked off on rent, or don't get that next car. That's why we have such a extreme supply in the used car side of the equation, and that can hurt the economy on the real side, but it doesn't impact food prices or fuel prices. And so all those reasons are why the markets are saying, look, at some point the Fed, and I agree with this, honestly, at some point, based on this reality and the fact that it will slow down the economy, because people can't both pay higher electricity bills and their rent, and things will happen. Things will be shaken out as a result. It's painful out there. That's going to create a scenario where the Fed's going to have to stop raising rates and stop letting assets float off of its book, which it's doing really slowly anyway. It just says it's doing it. It's not really doing it that much. And either stop raising rates or go back to cutting rates. And so you're right. Long answer, but it's important. I think there's so much going on here that there is a kind of game of chicken going on. Because at some point, the Fed, in order to maintain price stability, will have to recognize that the real economy, or GDP figures anyway, are very, very slow. And energy prices are very, very high. And they're going to have to back off. And that's what the market's waiting for and betting on. And the market, what it's doing right now, especially institutional investors, is saying, all right, well, we'll ride this down for now. But at some point, there is going to be a swoosh up, because at some point, the Fed's going to first stop raising rates as much, then go to neutral, and then the third part of that pivot, go to cutting rates.
One of the things that you'd mentioned, you'd mentioned Paul Volcker, in the 1980s. One of the major differences, I guess, in the economy at that time was that, that we didn't have quite the debt that we have in the system now, right? And so is that how much do you think the Fed can, really raise rates? I mean, there's presumably there's a ceiling based on how much debt there is in the system.
Yeah, so what's interesting is before the financial crisis, so like 2007 or so, the national debt stood at about $9 trillion, just the public debt part of it. And now it's at $31 trillion, right? So what's happened is it's basically tripled in the last 15 or so years, because it's been cheap to borrow, and because as an economy, the U.S. anyway, has not been able to produce enough to cover its cost of survival, right? So more debt, more money is borrowed in order to basically keep the budget running, and to basically keep the economy running at this sort of public federal level, as also the state level and the local levels. So that's been something that's been fed by cheaper rates, the ability to borrow more cheaply, and not sort of worry about how the economy is really growing, in order to be able to basically grow ourselves out as opposed to borrow ourselves out of this situation. And so now the amount of bonds that are on the Fed's books, a combination of treasury, government debt, as well as mortgage debt from the banks, equals $9 trillion. It equals the amount of total debt that we had before all of this stuff happened, before the financial crisis, before the Fed went to zero, before it created money to basically buy all this debt. So we're in a situation now where it's basically 3 times as bad as it was then. Mm-hmm. And as a result, again, this is another reason why this game of chicken that we were talking about, it's another factor, because at the end of the day, not just the Fed, but the Bank of England, European Central Bank, and so forth, they're all facing debt overwhelming crises at their sort of doorsteps. And the only way to ultimately keep that from exploding is to continue to keep rates low for the next round of borrowing to happen. Now, the U.S. happens to be in a position where it's its general cost of borrowing is still quite low relative, say, other emerging market countries or so forth. So we can still borrow at relatively low rates, but they're getting higher and higher. And that's going to have a cost to the budget. And that cost is going to basically have to borrow it against in order to pay it at a higher rate. And at some point, the government is going to have this sort of indoor conversation with the Federal Reserve, if it's not already happening, and saying, look, this is kind of getting very expensive to run here. I mean, and the markets are crashing, and we got an election, and people are complaining, and the economy is slowing. I'm like, what are you guys thinking? Meanwhile, that hasn't happened yet because inflation is so high that there's this belief that's perpetuated somehow that the Fed can stop inflation. Which it can't, and so this is a problem that we have right now. A lot of competing numbers and very high debt.
Yeah, I'm curious on your take on, obviously you can't predict the future, but when you're looking at what's coming up, energy costs are probably just going to keep going up. I mean, we're going to have winter in Europe, right?
Yep.
In the middle of a war in Ukraine. What do you see? What do you see happening over the next, say, 6 to 12 months? I mean, do you see any hope of getting inflation under control at all, given the where we are right now?
Yeah, I think inflation is going to remain high over that period of time for a couple of reasons. One is, as you mentioned, there's an energy crisis already happening in Europe, and that's before winter starts. Governments are trying to consider whether they can cap energy prices, whether they can help subsidize their people in order to not go sort of bust from having to pay their electricity bills. But the reality is that's either going to cost debt or it's just going to cost people more money or some combination, and it's not going to bring energy prices necessarily down if what is keeping them up are geopolitical tensions. So unless, say, Russia gets out of Ukraine and says, hey, sorry, I didn't mean it, and we'll open up all our pipelines and all sanctions, across Europe will be removed as opposed to being increased, which they will be in December on the energy side, then yeah, that could turn around. But if that doesn't happen, if none of that happens, even with all the warnings and even with all of the preparations that are going on in Europe, there's still going to be a winter and there's still going to be a lack of supply of storage, particularly of natural gas, going into the winter after a very, very hot summer where those supplies were already depleted because the summer was at historic highs and people had to cool their places and their storages of food and everything else. So, you have this really, this pending potentially harsh winter after an absolutely harsh summer, and that pushes energy prices up anyway. It's the same thing in the United States. We haven't really felt the same sort of crisis mode. I mean, I was just over in the UK for a couple of weeks. You definitely feel it there everywhere. We don't necessarily have, but anyone who looks at their energy bill, and I just saw my August bill. I was traveling. I just saw my August bill now, and I was like, oh my God, it's like twice as much as it was last August. Yeah. And I haven't even been home. And so, I think any business, any individual, any family is going to be really shocked by the end of their summer bills going into a winter that's not necessarily going to be easier. And that's going to absolutely come into play in all of this. So I don't see inflation coming down because of that. Food prices, transportation prices, fertilizer prices, all of those rely on some form of natural gas, or at least for the most part, fertilizer relies on it in order to basically create better sort of crop supplies. We're behind on that. There's famines kind of happening, there's droughts happening. And there's also the tensions between Ukraine and Europe, which are closing off wheat and other types of supply. So that's not going to change. So those bills are going to remain fairly high. What could come down are housing prices because people are just not wanting to spend 6% interest on their mortgages or refinancing. Obviously, that's going to die for a minute or during that time period. What that has meant so far are that rents have been increased because people are kind of stuck between having to pay that higher rent or getting a house, which they can't afford to buy. But at some point, if people can't pay that, there might be a little bit of a down, sort of a down movement in rents. But all those things together still equal relatively high inflation, literally no matter what the Fed has done. The Fed's raised rates now since March. And the only thing that's really happened is housing prices have kind of come down a bit. Everything else is sort of still high.
So when you look at all of these really complicated problems that we are dealing with financially, geopolitically, do you foresee some kind of, sort of a catastrophic event that culminates from all this? I'm just curious. It just seems like we've got so much going on in terms of debt, inflation, interest rates. Where does this, are you worried about some kind of, big problem up in the pipeline here?
Yeah, I mean, we're seeing some of these problems again coming, happening already. An energy crisis, food crises, famine increasing, sort of food poverty, fuel poverty increasing around the world, and I consider those crises.
Yeah.
Where generally crises look worse is when they impact the markets, because that's when we consider them a financial sort of less than just an individual economic crisis. And we've seen these, between the Dow, the S&P, the Nasdaq, other international markets are down, 25% this year, and since the Fed started increasing rates, and kind of precipitously with little sort of mini rallies along the way when there is that sort of collective thought, like, can they continue to do this? Like, are they not going to step in and help, because this is kind of, at the moment futile. So I don't necessarily see like a major other crash unless we have another epic war, like, if the Ukraine-Russia thing gets sort of bigger and it does become a kind of World War III, if really big things start to happen. But I do see this slow degradation over the near period.
Where does that culminate, though? How does that, what's I'm just trying to understand, like, where all this leads ultimately. Yeah,
I mean, where it leads to is a stagnant economy with a real shift, as we've already seen since COVID, and sort of the behavior of how people are employed. I don't think the idea of raising rates in order to tame wages and to tame the labor market really makes a lot of sense in this particular market. The labor market's changed so much. How people work has changed so much. I don't even think that our employment numbers actually represent the picture of employment. So there's a lot of confusion there. And where does that end? Well, if there becomes a situation where before, say, the Fed dials back rate hikes, and we're in a situation where it is very expensive to borrow, not just for governments, but for individuals, if they need to, or if they're using their credit cards, which themselves have rates rising on them, to pay their electricity bills because they need to keep their food, their homes either sort of warm in the winter, cool in the summer. I think all of that creates more it creates widespread economic angst, more so than we have right now. And what that usually indicates is more unrest, more political infighting, more civil unrest around the world. Because when people are uncertain and they have angst and they don't feel like their governments are listening, and certainly central banks aren't helping, and they're not even elected officials, they're just sort of like making things kind of worse. I think that results in a lot of potential violence and angst on that side. So I do think we see a lot of sort of crumbling of what we have right now. I talk about this in Permanent Distortion. This was already 2019, before even the pandemic, was the sort of highest year in terms of episodes of social unrest across the economic and global spectrum, sort of on record, and not necessarily meaning one big world war, but just in terms of the number and the breadth. Developing countries, developed countries, all that, and that was and then of course everything was shut down. But now we're entering the period where things are open and things are anxious. So I see all of those tensions rising, and I see. Again, the energy, the food, the fuel, the fertilizer, all of that staying pretty expensive, because there's no real infrastructure at the moment that kind of is in process to sort of shift that. We do have obviously new energy coming forward. We have other forms of renewable and sustainable energy that are coming onto the pipeline. But the problem is, what happens is if there's a need right now for what we have right now, and it doesn't have like in terms of energy, and it doesn't have the infrastructure there, and we're trying to sort of expand beyond that to tomorrow, it creates, again, more tension and more sort of flux. And where that all winds up, I mean, I do think we're going through a couple years now of a lot of chop until the Fed backs off, because that's one of the market's problems. There's probably a shift in government, in terms of we'll have another election, then we'll have probably into the next election, and around the world. We've had like our fifth or whatever, prime minister in the UK in the last X years. I mean, you just have a lot of change. And what that means is that there's no ability to really plan anything or to have anything take hold. It's all kind of reactive. And so that kind of keeps both markets and economies on edge. But I think ultimately the markets will benefit from a pivot by central banks, not in the next couple of months, but the third part of that pivot back to reducing rates. And I think that will catalyze more major rallies in the market. We'll see the cycle happen again.
So obviously, you've been part of this economy at a very hands-on level. You're a managing director at Goldman Sachs. We're at Lehman too, I believe. Putting your investor, hat on, so to speak. What do you think, just in broad strokes, what potential opportunities there are, for investors looking to say, well, gosh, the world is changing. I don't know where to put money. I'm not saying to give us financial advice, but what are some of the things that you think about as potential opportunities in the environment that we live in?
Yeah, so I started to mention, I think that in a different context, in what I said just before with respect to the energy markets, because I think what we've seen here, and also the fertilizer market, basically energy for power, energy for food, et cetera. I think those are the investment opportunities right now. And of course, some companies are very highly in debt, and some companies won't be able to raise capital in these markets because there's just a lot less to be gotten at cheaper rates now. But I think in general, the power companies that are well situated, that have a mixed portfolio of sort of, I'll call it old traditional sort of fossil fuel as well as renewable, sustainable sort of transition. I think those companies are going to be the ones that weather this. The utilities that do both can weather this. When I say weather, I mean weather the chop, but also be good investment opportunities, as well as the infrastructure for new energy as well will be a good investment opportunity. Again, the companies that have the ability to actually either finance themselves, pay for their financing, or are part of the need today as well as the need tomorrow. So I think those hybrid energy companies are really and the materials that they use. So that goes from lithium to nickel to all of the battery related or storage capacity related metals and materials will also be a part of where there's upside from an investment perspective. Anything that basically looks to, anything that's profiting now, as well as has a future path on an energy transition.
What do you think of nuclear energy? I'm just curious, just as an add-on to that. You talked a lot about some of the other things, but it seems nuclear, obviously it's got, a lot of countries are worried about the implications of that, but it also seems like potentially one of the best, ways to pave forward in this energy situation.
Yeah, I think, that goes by wind, solar, nuclear, geothermal. I mean, all of that's important. And from a nuclear perspective, obviously that's still tainted from years of disasters at nuclear plants. But that said, I think we've evolved a lot past some of that, and then learned from some of those mistakes. I'm not saying there won't ever be another disaster nuclear plant again, but certainly there's been progress in the technology, there's been progress in the safety measures, and there's been progress in the sort of capital that can be used for nuclear power. And one of the reasons we're seeing nuclear power come back online, or plants being resurrected and built across Europe, is because there's just a realization, kind of late, but a realization because of what's going on in Ukraine, that we just need to continue to advance other forms of energy, of power. Same thing in California. I mean, California, the biggest, let's just go wind and solar state in the United States. Governor Newsom is talking about and is basically focused on reinvigorating nuclear plants. And so there's that standpoint of nuclear power, and the companies that own those assets and the companies that actually can use those assets to produce power, as well as the materials, again, that go into that. So as well as uranium, which is one of the sort of feeding factors for having nuclear power. And so again, that sort of spectrum of the material and the energy sources, I think, are definitely big investment opportunities. And again, it's not like tomorrow, because we have a lot of chop in the market, but sometimes if you're looking way ahead, and I've always thought this on Wall Street, since being on Wall Street, is if you're looking, decide whether you're an investor or a trader, right? And if you are an investor and you have a reasonably longer term horizon, i.e. more than the next 6 or 12 months, these are all areas that for multiple reasons need to grow.
So the book, Nomi, is Permanent Distortion: How the Financial Markets Abandoned the Real Economy Forever. And that book, by the time we publish this, will be available presumably everywhere, Amazon,
Yes.
bookstores, etc. How else can we get a hold of you in terms of, finding some of the other things that you write, other things that you're producing?
Well, I do have a website where we do a reasonably good job of sort of compiling, whether it's my interviews, my writing, my books, and just my tweets, basically everything sort of that's home central, and that's www.nomiprins.com. And then from there, you can get the books, you can get all the social media handles and all of that. That's probably the best place. My Twitter handle's at Nomi Prins. So there's that, just real quick. But so I have been busy. There's a lot going on, and so there is a lot out there. And I did again. My whole mission here is to just to make the information available to people to be able to just be informed and go from there.
We appreciate that. Thank you so much for joining us on Wealth Formula Podcast today.
Thank you so much.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. I think Nomi is super smart. I was really excited to interview her, and hopefully you enjoyed it. And I think it's fascinating. I think I would highly recommend buying this book and reading it, because I think she's basically talking about what's happening in front of us that I think a lot of people know, but they're not really putting it into words, right? And then it's a great distortion. It is there's a completely distorted financial world that we live in. Doesn't mean you can't make money in it, but you have to understand it, right? You have to know the rules. You have to know the new rules, because the rules have changed. And so you have to be on top of that. Anyway, that's it for me this week on Wealth Formula Podcast. Hope you enjoyed the show. This is Buck Joffrey with Wealth Formula Podcast signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.